Brace yourself. The Reserve Bank of India has reportedly taken an eye-popping $60 billion short position against the US dollar. A move so audacious it's leaving economists and investors worldwide scratching their heads. Is this a daring strategy to bolster the sagging rupee or a reckless gamble that could wreak havoc on India's financial future? In this video, I will dive into the shocking details of what might be one of the biggest monetary missteps of the year. In a move that many are calling ill-advised, the RBI has reportedly taken an unprecedented step to stabilize the plummeting Indian rupee by building a colossal $60 billion short position against the US dollar in offshore markets. This aggressive intervention doesn't just break previous records, it obliterates them, raising serious questions about the risks involved and the underlying health of India's economy. While officials claim they are merely attempting to reduce the rupee's volatility, the sheer scale and reckless nature of this gamble suggests deeper issues and a desperate attempt to save face. What's worse, this strategy exposes the central bank to potentially massive losses if the dollar continues its upward trajectory. A scenario that's not just possible but a likely given in the current global economic conditions. Adding insult to injury, domestic traders in India are barred from engaging in similar activities due to strict regulations, highlighting a glaring double standard and an uneven playing field in market participation. The Indian rupee has been hitting record lows against the US dollar, reflecting a globally synchronized economic downturn. Historically, the rupee has been a reliable indicator of monetary and economic risk, and its current nosedive should be setting off alarm bells. Yet, instead of addressing the root causes, the RBI seems intent on applying band-aid solutions that do little more than mask the symptoms. The decline is driven by several factors: a strengthening US dollar, capital outflows, and domestic economic challenges. Investors are flocking to the safety of the dollar amid global uncertainties, putting currencies like the rupee under immense pressure. India's own economic slowdown only exacerbates the situation, making the rupee particularly vulnerable. Ignoring these realities, the RBI's short-sighted tactics appear more like a desperate attempt to maintain appearances and save face for the government rather than a calculated financial strategy. In response to the rupee's decline, the RBI has taken what only can be described as a reckless gamble by building a net short dollar position of approximately $60 billion in offshore NDF markets. This figure doesn't just dwarf the previous record of $19 billion, it raises serious concerns about the central bank's judgment. Traditionally, the RBI focused on managing volatility within its domestic market. Now, it's venturing into uncharted and risky territory by intervening heavily in overseas markets, ostensibly to target speculators betting against the rupee. The NDF market allows for speculation on currency movements without physical delivery, making it an attractive but risky avenue for the RBI to exert influence. By taking such a massive short position against the dollar, the RBI aims to scare off speculators. But let's be honest, this is akin to bringing a knife to a gunfight. If the dollar continues to strengthen, which all signs indicate it will, the RBI is setting itself up for colossal losses. The notional amount of $60 billion represents the potential exposure that could translate into devastating financial setbacks for the central bank and by extension the Indian economy. While the RBI freely engages in high-stakes gambling in the offshore NDF market, domestic traders in India are handcuffed by stringent regulations that prevent them from participating in similar currency speculation. India's currency markets are notoriously regulated, making it impossible for traders to hedge or counterbalance in the same way the RBI does. This double standard not only results in an uneven playing field but also undermines the integrity of India's financial markets. The asymmetry creates inefficiencies and distorts market signals, which are crucial for effective monetary policy. By muzzling domestic traders while the central banks runs wild offshore, the RBI is essentially saying, "Do as I say, not as I do," a stance that's both hypocritical and damaging to the economy. The RBI's aggressive intervention comes at a time when India's economy is flashing red warning signs. Recent data indicates that GDP growth slowed to a dismal 5.4% in the third quarter of 2024. A full percentage point lower than even the most pessimistic forecasts. This marks the slowest pace in almost 2 years and suggests the economy is losing momentum at an alarming rate. Bank loan growth is also slowing down sharply, mirroring trends seen in China but unfolding even more rapidly. From a high of nearly 20% growth in May, Loan growth has plummeted to just over 11% in November. The sharp contraction raises serious concerns about the health of India's shadow banking sector, a largely unregulated network that has been a significant driver of credit growth. The accelerating decline in lending rates within the sector increases fears of a disorderly financial unwinding, which could trigger a full-blown economic crisis. Despite the RBI's massive short position against the dollar, the rupee continues to hit new lows. This glaring ineffectiveness suggests the central bank's strategy is not just flawed but utterly misguided. The issues plaguing the rupee aren't just speculative pressures that can be wished away through heavy-handed intervention. They are deeply rooted in fundamental economic challenges that the RBI seems intent on ignoring. By focusing on curbing volatility through the NDF market, the RBI is essentially rearranging the deck chairs on the Titanic. Without addressing underlying issues like slowing economic growth, declining corporate earnings, and weakening consumer brand, these currency interventions are not just futile, they are a waste of valuable resources. The RBI's reckless position exposes it to significant financial risk. In the NDF market, the central bank is effectively betting that the dollar will weaken against the rupee, a bet that looks increasingly foolish given the global economic trends. If the rupee doesn't strengthen significantly, the RBI could incur losses amounting to several $billion when these contracts mature. These aren't just numbers on a balance sheet. Such losses would strain the RBI's financial resources, undermine its credibility, and severely hamper its ability to implement effective monetary policy. In a worst-case scenario, the central bank could find itself powerless in the face of an economic downturn, having squandered its ammunition on a misguided attempt to prop up the rupee. India isn't alone in facing economic challenges, but that doesn't excuse the RBI's missteps. Many emerging and developed economies are grappling with the slowing growth and currency depreciation against the US dollar. However, few are resorting to such extreme and risky measures as the RBI. Instead of learning from global counterparts and adopting more prudent policies, the RBI seems determined to chart its own disastrous course. Retailers in the United States, for example, are struggling with reduced consumer spending, a scenario echoed in India. Companies like Maruti Suzuki and Hindustan Unilever report weaker earnings and subdued demand. These are signs of systemic issues that require thoughtful policy responses, not knee-jerk reactions in the currency markets. Moreover, this intervention could backfire spectacularly. A large-scale operations in the NDF market might distort pricing and liquidity, leading to increased volatility, the very thing the RBI claims to be combating. Market participants may interpret the RBI's actions as a sign of desperation, further eroding confidence and accelerating capital outflows. The RBI's massive shot against the US dollar isn't just a bold move, it's a stupid one, aimed ostensibly at stabilizing the rupee and supporting the government's economic objectives. This strategy highlights deeper concerns about the health of India's economy and its vulnerability to global trends. The central bank is exposing itself and by extension the entire nation to potentially massive losses that could destabilize the financial system. Domestic traders shackled by strict restrictions can't engage in similar strategies, creating a distorted market that's anything but free or fair. As the rupee continues its downward spiral despite RBI's reckless gamble, it's clear that the central bank is fighting the wrong battle with the wrong weapons. India stands at a critical juncture. It's time for the RBI to stop gambling with the nation's financial structure and start addressing the structural economic challenges at hand. Reliance on aggressive and ill-conceived market interventions won't cut it. What India needs now are prudent policy decisions and structural reforms to navigate this complex economic landscape. The RBI's action thus far have been a misguided attempt to save face, but it's the nation's economic future that's truly at stake.